close your trade. Now we come to breakout and fake out. A breakout is when there was a trading range, and after the range, the price moved in one direction and formed a trend on that side. We call it a breakout. The advantage of a breakout is that if we can identify the start of a breakout, our risk ratio becomes very low. The risk is reduced and the profits are much higher. However, for this, it is essential to have a good understanding of volatile market conditions. A brother of breakout is found, which we call fake out. So to specialize in breakout, we need to understand market volatility. We understood that market conditions can be ranging or trending. We also discussed the way to identify them. Now we have to gauge market volatility. The measurement of market volatility is of price fluctuation over time, how much the market fluctuates and at what times. When there is high volatility in the market, there are big moves. In big moves, you can get big profits, but losses can also be big. So now what do we have to do? See, we discussed from the beginning, the market contracts, it expands, the market goes into a range, it goes into a trend. What is the trending period? It is a high volatility period. The ranging period is a low volatility period. So we need to use the low volatility period, meaning the ranging market, to anticipate potential breakouts. Now, what do we need to measure volatility? What is the first method we have to measure volatility? Moving average. With the moving average, we find out how much the price movement is. We need to apply two moving averages. When the gap between two moving averages is large, what does it mean? The market is volatile. When the gap between moving averages is small, it means the market has low volatility. Similarly, we looked at Bollinger Bands. When Bollinger Bands are close together, volatility is low. The Bollinger Bands are in expansion mode. Both are going up and down. If they are going in different directions, the market is volatile and in expansion mode. If they are close in a range or in a squeeze, then it is in contraction mode. The second indicator, as we discussed, its purpose was only to tell you the strength of the trade. It doesn't tell you the direction of the trend. So wear down an indicator whose purpose is to tell you about volatility. We call it ATR. So what does ATR do? ATR calculates your candles. By calculating the candles and their highs and tops, they find the average and conclude whether the market is highly volatile or low volatile. So now we have two types of breakouts. One is a continuation breakout and the other is a reversal breakout. Now, what is a continuation breakout? It is when the price was in an uptrend. After the uptrend, the price started consolidation. After consolidation, the price broke upwards and will go up again, or the price was going downwards. The price of the downtrend started consolidation, then the trend will continue going downwards, and there is a personal breakout. What happens in a breakout is that the price was going up or the price was going down. For example, the price was going down, then the price started consolidation. After starting consolidation, the price gave a breakout upwards. So what we will do is a reversal breakout.